Ever wonder why your bank only pays you 0.5% or so of interest on your money, while insurance companies can offer you 6 to 7% returns with the same safety? In this video, we're going to break down what banks really don't want you to know about your safe money. What's going on, everybody? My name is Kyle Demian with the Wealth Academy, and simply enough, banks pay so little on your checking and savings accounts because there's no commitment. And here's what I mean by that. You could tomorrow transfer and take out as much of that money as you want. So because the banks have no financial protection for what you can do with your money because it's so liquid, which is great for you, bad for the eyes of the bank. Because it's so liquid, they have no commitment from you on your money. So that's why they're not giving you a higher percent return. Now, here's a perfect example. If you lock up your money into a 6, 12, 18-month CD, some CDs now are paying, let's just say 4% per year. So because you lock up your money and you can earn 4% on a 12-month CD term, that's how that same bank can now offer you a 4% growth on your money. Simply enough because they know you're going to keep your money with them for that duration, right? Now, why can't banks offer anything more than 5%, 4%? Because banks don't know how long you'll leave your money with them, right? And they can't invest that money long term, especially if there's a chance that it could disappear tomorrow. Now, this is exactly where annuity companies come in. Annuities are offered by insurance companies, right? And annuities a lot of times have a surrender period, and they are a contract. And that contract protects the insurance company. Protects them from what? It makes them aware that you have a long-term mindset with your money for growth. Now, here's how it benefits you and also how it benefits them. Because they know for a fact that it's not as likely as maybe account owners at a bank that you're going to pull out and take out all of your money in any given year. The annuity company, the insurance company, can invest your money for long-term profitability for them, which then gives you back greater interest than you can earn from checking or savings accounts. Right? Now, here's an example. Some of the annuity companies that we work with have $300 billion plus of assets, right? And when you have that much money that you can invest and do these different things with, you can make very smart and strategic moves in the market. Now, simply enough, insurance companies make money through options contracts that they purchased for their annuity account holders. These option contracts can expire worthless, which is how they protect you on the downside of, market corrections or when the market's correcting. You don't get exposed to any of that risk because those options expired worthless and they didn't make any money. So if the insurance company isn't losing any money or going backwards in the stock market, that's how they can protect you from going backwards and losing any money in the market as well. Now, those same options contracts, if they do well and the underlying index that the option is invested in goes up, that's how they allow you to participate in the growth as well. And so for long-term money that you don't plan on accessing or using right away, consider looking at an indexed annuity. Indexed annuities are not the same annuities that you may be thinking of from 20 years ago. They're also not income annuities. I have another video for that I can link somewhere in here where you can check out the 4 different types of annuities. But if you're looking for something that offers you safe growth for a long-term account that you plan to have, the rest of your life, or maybe at least the next 10 years, consider an index annuity. Now, one other limitation with annuities, which is not really a limitation, and here's why. But most annuities offer you a free partial withdrawal, meaning this is the amount of money that you can take every year from your account. Now, the traditional rule of thumb from retirement accounts is that you can access 4% per year as the safe withdrawal rate. Okay. So if you can access 4% per year to safely withdraw down your retirement accounts when you're retired, that is the formula that should allow your money to last you 30 years and for a long, successful, happy retirement. These annuity companies, most of them allow you to offer anywhere from 5 to 10% every single year. So the idea is this is the money that you can safely take from in your retirement years while it's still growing and accumulating at maybe 5, 6, 7% interest, but isn't exposing you to that risk. An annuity isn't for everybody. There are pros, there are cons, just like anything. But for any of your safe money that you want out of the stock market, that you're looking for safe, protected growth, consider an index annuity, right? It doesn't have to be a fit for all of your money, but a portion of your money, right? You don't want to keep all of your eggs in one basket. And this index annuity is a great basket for your safe money. If you guys have questions about index annuities, want to learn more, I'll have a link below that you guys can go down there and schedule a call, and we can chat one-on-one to see if an index annuity will be right for you. And if you made it to the end of this video and you enjoyed it, please just give it a like, subscribe, follow along for other retirement content that I release, and leave your questions below in the comments section. And I'll answer it here, or maybe I'll just create another video out of it. Thank you guys for your support, for your following, and I'll see you guys on the next video. Take care.